Okay, we're back, folks. We've got Bill Chapman of the Trend Reaction on the line. Bill, are you there?
Yeah, I am. Good morning, Larry. How are you today?
I'm good. Listen, folks, Bill was listening to Tom Hugard yesterday, and he had some information regarding that 500-day and 72 weeks, and I sent this on to Tom yesterday, and he really liked it, and I'm sure he's listening today because he said he was going to come in. But you want to go ahead and tell us the story behind this? I remember meeting Jim Sloman, and I've known Wells Wilder for a long time, and I remember meeting Sloman. Wells Wilder said he's the smartest human being that he ever met. But why don't you go ahead and take over? We've got a good 15 minutes, so go right ahead, Bill.
Well, if you've got the first chart set up there, I tried to replicate as closely as I could what Tom had put out there yesterday morning with his charts, and I added some specific details because what Tom was, and Tom, it's quite incredible that he saw this. He's very astute in his market observations and his market thinking. But what he picked up on was one of the fundamental pieces of the Delta phenomenon, which was discovered by Jim Sloman and marketed by Wells Wilder. But what Tom had found was basically there's a hidden order in all markets. And if you notice what Tom was talking about, there's 500 days and 72 weeks. Well, if you break that down, it's actually 504 days divided by 28 days per lunar month, which is 18 months. And at 18 months and 4 weeks, there's your 72 weeks.
Mm-hmm. Wow.
And if you look at where I had indicated, I put the 1, 2, 3, 4, the vertical arrows in that Tom had put in yesterday, and his turning points. Mm-hmm. But you can see where they all start. His number 1 starts with the number 1 just before the red line. Mm-hmm. His number 4 starts at the number 1 just before the red line. Mm-hmm. And ends at just about 0.6, or number 2, on his first line there, and which is his 72 weeks. But what the thing about the Delta phenomenon is that the premise is that markets repeat directly or inversely relative to the total interaction of the sun, the moon, and the earth. So what you're seeing is on a weekly basis, and this is an annual chart that you're looking at. Every year, it has a different color code. So you have a red year, a blue year, a yellow year, a green year, and then it repeats. Because the sun and the moon and the earth, it's 4 rotations of the earth around the sun, 4 rotations of the moon around the earth. And that's basically the breakdown of this concept. And what Tom was able to also see was that markets will repeat directly or inversely every 4 lunar months. So if you go to chart number 2.
Okay, give me 1 second. I have to get that up, Bill. It'll only take me a second here to get it. And let's see. Just a second here. There we go. What I have to do is I have to get back into the Tiger Den and put this up here to look at it. We have a question from one of our listeners. Did you ever meet Chris Carolyn?
I have never had the pleasure.
Because he does some really fabulous work in this area also. So, mm-hmm. Yeah, go right ahead. There's chart 2.
So on chart 2, you can see where Tom picked up on the 22 to 2011. And the one thing he was saying, he doesn't know why this breaks down. Because sometimes it just seems to disappear. Well, what happens is that it compresses. Mm-hmm. So you're not getting these dramatic shifts that you would normally get. the 72-week period or the 504 days, it's in there. You just have to do the count.
Now, we have another question, Bill. Do you do any Elliott wave analysis along with these numbers that you have here?
I have I'm not a really big fan of Elliott wave. I've never been able to quite to make it work, and I find that people who I've just never been able to, it goes beyond my way of thinking. Mm-hmm. So I don't do the Elliott wave.
Okay.
But I do basically a delta count. So what you have in chart 2 is where you had the final break in 2011 down to, you can see from 0.7 to 0.8, and that being 72 weeks, 504 days. Now, the thing in Delta is that it's not exact. It can be 67 weeks. It can be 72 weeks. It can be 76 weeks.
Mm-hmm. What do you do to make up for the difference?
Estimable. You see.
Okay. One of the questions that we're getting from the den here is, what do you do if you go to 72 weeks and it stretches out to 76? Do you stay long or short during those 2 weeks, or how do you handle that?
You stay long. Well, quite naturally, you're also going to have your secondary indicators that you're following. You're going to have your moving averages. You're going to have your Fibonacci levels.
Okay.
And those are the decision-making pieces. What you basically have here with the Delta is a roadmap to what the market should look like during the year. Mm-hmm. Now, I forecast out 2 years in advance with the Delta. And you can ask any of my clients, I come pretty damn close to what actually occurs out there in the marketplace.
Okay.
Well, that's interesting. The secondary indicators are what's really leading you through this marketplace, and it's unfortunate. We get a lot of people get an us versus them mentality when it comes to the market. The market's against me. It's not. The market is telling you exactly what's going to happen. And so many people, I see on so many different sites, all these gurus out there who just base their analysis on price, as opposed to looking at the secondary indicators, the breadth indicators, the spreads between the cash and the futures, the premiums, the ticky, the trim. They're all telling you where this market is headed.
Hey, Bill, we've got
a commercial.
Yeah, we have a commercial. We'll have you on again soon. Thanks for joining us. We put your information there, so if people want to reach you, Trend Reaction. Bill Chapman, thank you so much for joining us today, my friend.
No problem. Good talking to you, Larry. Take care.
Good talking to you, Bill.